I can't hear anything.
Okay, let's have a look. We're trying something a little new. Are we on now?
Yeah, we're
Okay.
live. Sorry about that.
We are live. Okay, Stuart and I are now in our studio. As you can see, he's much taller of the two. But first of all, let's just make sure we got all the tech right, Stuart.
Excellent. Thanks, Alex. Sorry about that. If you can hear my voice, see our pretty faces, or some say not so pretty. And there's a little presentation underneath this with reality restored. If you can see and hear all of that, can you give us a high five on the control panel on the right-hand side? Oh, lovely. Thanks. There we go. Flying through. Excellent. It is working. I think we haven't messed it up yet.
We're certainly trying our best there. Oh, good. Thank you very much. Well, nice to see so many people in our monthly webinar. And it is an opportunity for you to pose questions about the Biznews portfolio. We'll be giving you more insights into that in just a moment. I've got a couple of stocks that I'm going to be talking about in some detail. We were going to change the portfolio, decided to do a little bit more homework before that, but I'm sure there are going to be lots of questions about those issues. First though, Stuart, how do the questions work?
Excellent, thanks, Alec. I see we've got one already, so it is known by some. There's just little questions drop-down menu on the control panel on your right-hand side of your screen there. If you click on that, please pass your questions through on there, and I'll pass them on to Alec as we run through the discussion. But we do like to keep this one very conversational, so please don't wait with those questions. You can put them through as soon as possible.
Fabulous. All right, we're going to switch our cameras off so we can give you the presentation now, which I'm sure, given the hands that were raised, is coming through nice. There we go, loud and clear. Just make absolutely sure. Got to get the tech right when you're doing a webinar, and we've been doing this now for nearly 6 years, would you believe? And we keep learning every day from our software. Okay, reality restored. What does that mean? Those of you who were with us last month will recall that the portfolio was up by 12% in the month itself, with 2/3 of the stocks in the portfolio going up by double figures. It was a crazy month in August. September, reality restored, but what we have to look at, the real number there, and I just put that underneath in brackets, is the compound annual growth rate. In other words, the money that has risen over the last nearly 6 years. It's 5 3/4 years as of today, because we started the portfolio in December. So we're now in the end of September. Was 21.6% in dollar terms and 30.5% in rands. As you can see, we have had a lot of support from Amazon.com. We know about that. It was a great investment. It's transformed this portfolio, but also the others have also done pretty well. Moving on to the individual surges, and I actually put this together just to give you an idea of what happened in August and what happened in September, going back to July, which was like the end of the bounce, of the first bounce of the pandemic or the post-pandemic. If you recall, in March, Mr. Market completely panicked when the COVID-19 pandemic came across. The share prices plummeted. We took advantage. We bought Sasol at 28 Rand and were able to sell it at 140 Rand. We bought into Discovery as well at a 80%. Well, we've had an 80% uplift from that, and the rest of them we just held on to and enjoyed the ride. But if you have a look at what happened in the last month in September, August was just ridiculously high. As you can see, the portfolio put in 1.5 million Rand. Remember, this is a portfolio that actually started with 2 million Rand in 2014. So it was a quite extraordinary growth in that month. And then in September, it came back to normal. So I suppose with hindsight, if you'd been brilliant, you would have sold in August and then bought back in September. But this is a long-term portfolio. The average holding time for us is forever. And as a consequence of that, the way I like to look at this is we go back the latest figure and we compare that with July, and you can see the portfolio is well structured. It was up about 3%. Interestingly to see, the performers or the big performers, Discovery, whose results were out recently, is up 12.5% from July. I'm going to ignore August for the moment as a little bit of Mr. Market's manic phase. It's also been a very good couple of months for Apple and Adobe, and nothing really that fell excepting for Spotify. And I'm not worried about that. It's showing a good profit for us. There was maybe a lot of heat in the Spotify share price after they did the deal with Joe Rogan. And then Naspers, which I'm a little more concerned about, but not enough concern, and I'll explain that later, to actually sell the shares in the portfolio. And the rest of them pretty level pegging. So I think that gives the things in perspective. What we've also done this month, I completely forgot that Microsoft actually pays dividends. So we've been able to add we got a dividend from Apple of 82 cents. Nice to see that. And you look back at Apple on the 6th of August, 2015, when we first added to the portfolio, or the first dividend that we received from Apple in the portfolio was 52 cents. That's now at 82 cents. And if you were to work that out in rands, you'd see that there's been a significant increase in the Apple payment to shareholders. So a really, really good stock to buy on the basis of Warren Buffett's perspective of buying and holding it forever. But you can see their Microsoft shares or dividend payment has gone from 42 cents to 51 cents. They don't seem to have the same problem in the United States with the companies about paying out dividends to shareholders as we seem to appear to have here in South Africa, particularly with the banks in South Africa to preserve capital. Anyway, there was $1,554, which has been added to the portfolio. At the size of the portfolio, it doesn't make much of a difference, but it's nice it's more of a rounding error really, but it's nice to just make sure that we keep everything absolutely accurate. You will recall that we started buying Slack and 2U 3 months ago. This is the final chunk of purchases. Why we do this, why we buy companies, the offshore companies in stages of 3, is to try and remove the Rand impact on share prices, as well as to reduce the volatility in the share prices. Unfortunately, both of those shares we bought very high last month, but fortunately the share prices come down again in September, and so purchasing them today or at yesterday's prices, we were able to get a whole lot more money for the roughly $9,000 that we put into each of these shares in the quarter, in the month. So that brings us to the portfolio generally, and what I've put there is the pandemic rise. So this portfolio has been structured for the future. My thesis, and those of you who read the newsletter, the Rational Perspective newsletter this morning, is that the pandemic, the COVID-19 pandemic, or more rather the reaction by governments to it in the way that they have boosted the stimulus packages, is going to support those companies that went into the pandemic positioned for the future, and is going to punish those companies that are positioned the other way. And in fact, if you have a look at what happened last night, and I wrote about that this morning, on Wall Street, you had the Dow, which was down by 2%, 3% for most of the day. That's the old economy stocks, whereas the NASDAQ finished flat, and most of the stocks in this portfolio actually went up yesterday. So what it's telling you is that Mr. Market is now paying much more attention, or investors generally, in that thesis of the companies that are well positioned for the future are being accelerated. They're being pushed more strongly by the consequences of the pandemic, whereas those companies that were on the other side of the scale, old economy companies, are being punished. And basically, when you have a look at it in perspective, after the collapse of share prices, as you can see in March 2020, our portfolio, by the way, did not collapse. It held pretty steady. The rise, though, the post-pandemic rise has been 53%, which has been quite exceptional in every circumstance. Again, just reinforcing the positioning of the portfolio into exponential companies. You can see on the right-hand side there that the disappointments at this point are Wilson Bailey. Not too surprising there. The reason why Wilson Bailey rose so significantly at the time that we bought into it was there was a bid for the company for the company's Australian assets by a Chinese bidder. It looks like that seems to have now disappeared. And also there's a little concern, no doubt, from South African investors that the much promised infrastructure investment may not happen. Well, I think that if you have a look at the economic data that's come out in the last little while, it's absolutely certain that the government of South Africa is going to have to really get busy in promoting economic growth, and the way they'll be focusing it is in the construction sector. We've had the President Ramaphosa already saying that a number of times, and if you are the last blue chip company left in that sector, surely to goodness you're poised for the future. So we won't be touching that shareholding. The other ones that we won't be touching are the Slack and 2U shares. We've now completed our buying program in both of those, and as you can see, they're showing double-digit declines in US dollar terms. That's because we bought them also at the peak of the most recent peak in August, and that has distorted the prices that we paid for them. But again, no problem. That is a long-term investment in both of those. Naspers has come back to only an 11% gain now in US dollar terms, and that's over the past year, which is solid, 24% in rands, pretty solid. But on the other hand, there's a very good reason for that, which we'll discuss in some detail later on. But Stu, I see there's some questions.
Yes, thanks, Alec. Just on the general thing, Ms. Hennessy would like to know, do you think it's a good idea to wait until after the US elections before investing again?
Mr. Seamus.
Yeah.
These Irish names, Stu. You should try Siobhan one day. Siobhan. How would you pronounce that? Siobhan. Anyway, I only know it because I have extended family who live in Ireland. And anyway, Seamus. No, this is a portfolio for the long term. I love what Warren Buffett says. The US economy will survive Donald Trump because it survived much worse in the future. The point that I've been making continuously, and certainly did in August, was that the surge in August was really due to an interpretation by US investors that the Trump bump would continue, that in fact he could get elected. It was also a increase or a view that that after the election, that basically worked into the market was that Trump could not win. But now there's not so much certainty that Trump could not win. So as a consequence of that, we had that surge in August. But remember, the real movement in markets has been caused by these massive stimulus packages that have gone in. In August, they were anticipating that the fourth stimulus package would be injected into the US economy, a couple $1 trillion more. That now seems to be postponed until after the election. Will Joe Biden go ahead with it? Well, if he gets elected, almost certainly he will. But there's going to be, there's so many factors that would be influencing the end. To try and project the future, I think, is probably not a smart thing. When you're investing and you're investing forever, it's not a bad idea to be doing your investing now. In fact, if you buy into this portfolio today, remember our philosophy is you buy 1/3 now, 1/3 the following month, so that would be October, 1/3 would be after the election in November. So you'd be spacing it over that period. These stocks have all been selected because of their long-term potential. Politicians will come and go, but these companies, I think, will be still around long, long, long after we've even forgotten about Trump and Biden.
Thanks, Alec. Thomas just wants some clarification. He's asked, is your percentage rise annual or since inception?
No, the percentage rise is, and I'll tell you what happened, Thomas, on this one. I started off in the early years by just doing a simple arithmetic and taking the increase over a period and then dividing, say, after 3 years and just dividing it by 3. And then we were getting ridiculous numbers. Excuse me. We were getting ridiculous numbers of 50 or 60% growth. And that wasn't right either. The calculations weren't correct, because if you think about it, if you start with 100 and in year one you rise 20% for argument's sake, then in year two, you're now calculating on 120. You're getting growth on that extra 20. So the way to calculate it correctly is through compound annual growth rates, and they are far lower than arithmetic growth rates. You can see that we started at 2,254 or 2.2 million rands, for instance. We now, as you can see from there, are 10.4 million rand. So if you go from 10.4 million rand and you divide it by 2.2 million rand, that's up by nearly 5 times. It's been going 5 years. So you say, oh, it's 100% a year. Of course, that's not right, because you aren't calculating the increase on the additional capital that you're generating every year. So by using the correct calculations, it shows you that if you are to make, in rand terms, 30% a year, the power of compound interest, or what Warren Buffett calls the 8th wonder of the world. If you make 30% compound a year in almost 6 years, you'll go from 2.2 million to 10.4 million. That's how big the increase will be. So those numbers are compounded rather than arithmetically calculated.
Yash has a triple-barreled question here, Alec. He says, would you recommend buying Apple, Spotify, and Adobe? And then his follow-up is, would also like to hear your view on Tesla, Nvidia, and Johnson & Johnson.
Okay, on the first three, I can comment because I'm happy with those 3 stocks. They're in the portfolio. If you buy them over the next 3 months, 1/3, 1/3, 1/3, I don't think you would be disappointed. Of the 3, I do prefer Netflix to Adobe. I just think that Adobe's had an incredible run, whereas Netflix, anything under $500 a share, does appear to be offering great value. I think both Apple it's now being recognized, and after the 4-for-1 share split on Apple, it's now come back to a reasonable price, which is around $400 in the old terms. Remember, we bought in there at $120, so we've done very, very well out of it. But I'm quite happy with Apple because of the recognition by society or by investors generally that the real value there is in the ecosystem. And Apple's latest, every year in September, they unleash or unveil their new products for the year ahead. And they've just unveiled those products, and they didn't even mention a new iPhone, which is the first time probably ever that they've done that. That is usually what the market is looking for. What is the new, latest, greatest iPhone going to be like from Apple, and how much is it going to push up the sales? And as a consequence, can we buy the shares? This year, Apple's reflective of the ecosystem base that they're on. Their new products were the new watch, which interestingly enough has an oximeter in it as well. So you can monitor with a new Apple Watch how much oxygen is in your bloodstream. I mean, believe it or not, it's extraordinary. But of course, that's for COVID, because if your oxygen in your bloodstream starts falling, that's when you need to go to hospital, because if they can catch you early, they can address it. And anyway, it's become a health. We used to hear about science fiction that there would be little chips in your body that would tell you if any parts of your body are going wrong. Well, you don't need it in your body anymore. You've got an Apple Watch. So it not only does it show your heart rate, but it even has an oximeter in it. The other, so that was the first, Apple Watch 6, I think it is. And the other big thing that they decided to unleash this year, unveil this year, was the new look iPad, which is a bit irritating for us here at Biznews because we've all just acquired iPads. But anyway, it's a phenomenal. Those of you who've never ever used an iPad before, it changes your life. I don't know how much better the new version of the iPad will be, but certainly it does dispense with laborious note taking and so on. But the point about all of that was that's Apple. You know, with an Apple, if you want to transfer from one Apple machine to another, you do it with a thing called AirDrop. If you've got 2 Apple machines in a room and you're looking for the Wi-Fi code, they talk to each other and they update codes. There's a value of this ecosystem once you're in the Apple ecosystem is just extraordinary, and that's why the share price is now being so well valued. and at $1.8 trillion rather than $2 trillion as market cap, you're getting a bit of a discount on what happened in August. So Apple, very good. Spotify, I think I've spoken about that one till the cows come home. The real story there is on podcasting, and we've invested heavily in podcasting here at Biznews. And Adobe is a phenomenal software company. Again, you can see how PDFs are changing the world. By the way, I hope you guys have downloaded the new Biznews PDF. We're very proud of it last week. Just makes things so much easier. You can click through to stories. PDF is an amazing product, and it's now becoming more and more ubiquitous. But when I take Adobe versus Netflix, especially after Netflix's phenomenal movie set in Cape Town. If you haven't seen it yet, go and see it. My octopus teacher, I watched it last night, and well, it really is one of the best movies I've seen to come out of South Africa. And that just shows you the kind of original stuff that Netflix is doing now. And at under $500 a share at Netflix, I would prefer that to Adobe, but to go along with them. The other three, I can't really comment on. NVIDIA, I keep getting kicked in the butt to say, go and do your research on NVIDIA. I know they've done the deal now with ARM. It looks like an excellent deal for NVIDIA. It really, really looks like an exciting company. I just don't know enough about it to be able to suggest. Johnson & Johnson, with the play that they've got on the new vaccine, might well be in the price. Again, I haven't done my research on that one. I don't know the company well enough to be able to give you a thumbs up or down. And Tesla, by any standards, Tesla is overpriced. Even Elon Musk says it's overpriced. So I'd be a bit cautious about it, but he's got a huge fan club, and who knows, they could take it higher still. But Tesla is just too volatile for my more conservative nature when it comes to investing.
Thanks, Alec. I've just put the link to the interview Linda had with the filmmaker, what's his name, Craig Foster of My Octopus Teacher. I was saying our family also watched it this weekend, and there a few tears around the house with that documentary.
Only a few. It's brilliant. It's phenomenal. But I think the point there, Stu, is you wouldn't ever see a movie like that if it weren't for Netflix. They really are pushing the envelope. They're doing a lot of creative stuff, and they're going to benefit from it. They are benefiting from it. They're growing rapidly. It's just a great company to be involved with, as is Apple, as is Adobe, as are the others that we have in the portfolio.
There's a big shift in our house away from DSTV to Netflix, which is happening at the moment. So I think it's a big trend that I think people should jump on.
Yeah, if that question was, would you be buying multi-choice? I'd say no. Not at all. Although Netflix is doing a deal with MultiChoice in Africa, so we're going to have to see how that all pans out. Perhaps it's to both benefit.
Sure. You mentioned health. Dion just wants to know what, in your opinion, are the long-term prospects for health and green stocks?
Health stocks, the one that I know a bit about is Aspen. I really like Aspen. We had Stephen Sard on our Rational Radio 2 weeks ago. By the way, what we've done with Rational Radio, which is our Monday show just for premium subscribers, is that we are now taking a focus on a company, and usually an investable company. So we'll look at a company that we want to learn more about. David Shapiro is our regular guest. We then get in or one of the asset managers or money managers who knows that company well, often somebody who's invested in that company. And then that money manager and David pose questions to the CEO. 2 weeks ago, we had Stephen Sard. I thought he came across extremely well. He explained in many ways that the company has restructured, refocused. Remember, that was 400 Rand a share a couple of years ago. They've gone through a tough couple of years at Aspen. They are now around 100 Rand a share, just so a quarter of what you would have paid at the peak. And everything about what Stephen's doing. Remember, he's been running that company for nearly 30 years now. He built it, he started it, and he knows exactly what he's up to. They've refocused the business away from oncology, which is cancer treatment, where most of the pharma companies have been spending most of their time, because in their home markets, that's where all the money is made, is out of cancer treatment. Whereas what Aspen has done is had a look more or focus more in the emerging markets, And then you get a thing like COVID with dexamethasone, which is a drug that Aspen makes, which the whole world wants at the moment. Stephen said in that conversation, he was literally getting phone calls from heads of state saying, how can we just secure our country's supply of various drugs that Aspen makes? It's at 100 Rand a share. It is, for me, that would be my bet on the health sector. And health is going to become more and more important, particularly here in South Africa, where we've learned a very big lesson. Whereas in the past, Aspen might have been forgotten by government or almost attacked by the Zuma government anyway. The Ramaphosa government is fully aware of the value that it has to have a strategic company like that, a global business in the health field based in South Africa. If I was to have a play on the health sector, that would be the one. It's cheap, very cheap. Stephen says 8 times EBITDA. If you were to use Adrian Saville from Canon's estimations, it's 10 times. It's still very, very reasonable when you consider the asset base there and the growth potential. So that would be my play. I know they're much smarter guys than, I mean, doesn't say much, but than me, who are looking at the biotech stocks in America, and they've done very well out of them. It's not a field I know much about, but I like the Aspen story very much.
Thanks, Alec. I know you mentioned Naspers in your newsletter yesterday, I think. Chaman Prem just wants to know, would you say Prosus is equally at risk as is Naspers?
Definitely, and let's have a look at that. As you can see, the individual stock performance, Naspers has been the worst performer in our portfolio, but it's 25%. It's only over a year, and you can see how Amazon has really pulled us up. But I pulled this graph out because I think this is the reason. It explains why we haven't sold Naspers. Now, what's going on with Naspers at the moment is that Donald Trump has got it into his head that the Chinese app makers are in cahoots with the Chinese government. And a little bit like, if you remember Cambridge Analytics, which was the company that Facebook was involved with, which scooped out lots of personal information from Facebook and used it for political ends. What's happening now is that the Chinese, and particularly through TikTok, which is a subsidiary of ByteDance, which is itself a subsidiary of SoftBank, the company that started Uber and had a big stake in Yahoo, Mr. Son, a very famous 100 billion vision dollars, that is Vision Fund, etc. Anyway, so that's ByteDance. They own TikTok, which has become an app that's taken fire in the United States. And then Tencent, which is where Naspers has its valuation from, has got WeChat in the United States, and Donald Trump has banned both of them. The companies did get a temporary reprieve on Sunday night when a judge temporarily said you can't ban them yet, but it is going to happen. As long as Trump is in the White House, that's going to happen, and we're very hard for Biden to reverse a rule like that. Why? Well, because the antagonism towards China is high, and secondly, these apps do pull information from private individuals, and Tencent has made no secret of the fact that it's very close to the Chinese government. In fact, the founder, Pony Ma, is intimately involved in the Chinese Politburo, whatever they call it, in the executive committee of all the communists who are together as a politics. And he hasn't distanced himself. If the Chinese government tell Tencent to do something, they do. So that's where we are. But when you have a look at this graph, it tells you that despite the issues that Tencent is going through, the share price of Tencent, which is the yellow one, has outperformed significantly the share price of Naspers. Now, there was a superb article in the Financial Mail a couple of weeks ago where Rob Rose interviewed somebody who is very upset about the listing of Prosus in Amsterdam. It was supposed to unlock value, and he maintains it hasn't unlocked value. If you have a look at Naspers, the discount that Naspers is running at now just to its 10-cent shareholding is approaching 50%. So what we're saying there is that if Naspers were to sell its 10-cent shares, the Naspers share price would go up by 50% plus. So if it unbundled its Naspers shares, for instance, and that's the big risk of not owning Naspers right now, although the Naspers management have continuously told us that they are not going to unbundle the shareholding that they have in Tencent. If that discount gets any bigger than it is at the moment, it's going to be irresistible for them to, because shareholders in Naspers are going to force them, Naspers and, if you like, Prosus at the same time. So that's my view. Naspers is a massively undervalued stock. Tencent, you see the yellow line there. The US ban hasn't really hurt Tencent yet. Where the problem could come in is if it accelerates, which is likely in the next few weeks ahead of the election. Tencent has also got very big stakes in the American gaming market. It's invested $20 billion in gaming companies in the United States, and that's where Tencent makes its money. It makes about a third of its revenues from gaming, video games, if you like. So that's really the risk, that there's a risk to Tencent's share price, but when you look at Naspers, your risk is not owning it because of the huge discount at which it's trading at the moment. And if one day the executives of Naspers the board of Naspers decide that they need to eliminate that discount, and if they decide to unbundle the Tencent shares, and you don't own the share, you're going to be losing the potential of an overnight uplift of 50%. And I guess that's where that's one of the reasons why we're holding on to Naspers, because you really at these with that story as being the main story, you can't really not have it in your portfolio if you're in South Africa.
Thanks. Just a follow up on Naspers from Aresta. She asks, is Tencent held directly by Naspers and Prosus?
Yes, the way it works, Aresta, is that Prosus owns the shares in Tencent, and then Naspers owns the shares in Prosus. So that's really, it's a roundabout route. They did that through the listing in Amsterdam, but both Naspers and Prosus, without getting into the complications or the complexities of it, both of those, their biggest asset is Tencent, and that the value of that asset exceeds by about 50% now, just of that asset, the share price, the market cap of those companies. So what you're getting is a 50% or a big discount on Tencent, plus everything else that's in Naspers you get for free.
Alec, there's a question from Oratile. Since the portfolio has been built for the future, have you any thoughts on the recent Snowflake IPO, considering it for inclusion maybe?
Sure, that was a real embarrassment at Goldman Sachs and a big win for everybody who was given the opportunity to get invested in Snowflake before the listing. It's not one that I know enough about, Oratile, to be able to pass any comments. So, Warren Buffett says there are three boxes on your table, on his table. The first box is those companies that you must invest in. He says it's a very, very small box. The second box is those companies that you mustn't invest in. That's a slightly bigger box. And the third box is the too tough to calls, and given the 100% premium of Snowflake on its pre-listing price, that would very much go into the too tough to call for me.
Just on that, Tebogo asked about Snowflake, but he also asked which box would Salesforce fall into?
Also too tough to call at the moment. Salesforce it's been a phenomenal company, a very well run. Benioff is obviously a very competent entrepreneur. It's one of those that just too tough for me to call.
Thanks. There's a few questions coming through on Naspers and Prosus. Guy wants to know, please mention the discount of Prosus and any thoughts on the listing of Ant Financial Services. And then just on that, Pete wants to know, do you invest in Naspers or Prosus?
I'll start with the easier one first, Pete, Naspers. That's the one to buy. We are South Africans, so we've got rands to spend. And secondly, and that's, you'll see in the portfolio, we decided to put our rands into certain South African stocks. Naspers is the one, also because it's a bigger discount. Remember, you are buying Naspers or Prosus on the basis that they're trading at a huge discount to their 10-cent shareholding. I don't have the up-to-date figure, but the last number I looked at, it's easy. In fact, what we should do, because Naspers is so important to South African investors, we should actually run that figure daily, because it does give you it's very easy to do. You just calculate the shareholding that Naspers has in Prosus, and then what Prosus has in 10-cent, and you can work out what the discounts are. But Naspers' discount, and it's increased, as you can see from that graph that we have on the table. It's actually widened the discount, and substantially. It's widened since June. Now, that could be due to investors just leaving South Africa. We published again in the Rational Perspective newsletter this week a graph from Kevin Lings, which shows that the shareholding or the ownership of South African bonds, South African government bonds, which was usually around 40% of the total, has now dropped to around 30%, and has been heading lower. So foreigners are selling South African assets, locals are buying them up. And this graph also shows you that foreigners have been selling Naspers shares. It is really, really cheap when you have a look at it on a see-through basis. The discount is enormous. So I'd certainly be buying Naspers rather than Prosus.
Exactly. I know we've spoken a lot about Spotify, but Gail Stevenson wants to know if you have any view on Shopify.
No, Gail. Tough question. Gail's from Newcastle, so you know she's a long-time supporter of Biznews, and we Newcastle people stick together. Sorry, Gail, that's too tough for me. I've looked at it. I've looked at Shopify, and I can't work out yet when it will be valued. But I guess the idea that one should always do is, with every single share that you invest in, if you can see your intrinsic value, you work back the intrinsic value by looking ahead to what that company is going to deliver to you over a period of time. And we can't really work on dividends, we more work on the earnings. So that's, and it's sometimes a very personal thing, because you could look at Shopify and say, okay, I love this company, it's going to grow 30% a year. If I work that into my in a compounded growth into my Excel spreadsheet, I come out with a price of X, and I usually use for me, I use a number of 10 years. That's, some people will go as much as 20 years. But if I'm happy that I'm getting a margin of safety, a 20% discount at the current share price on what I believe that this company is worth, just based on what its profits are going to be over the next 10 years, and I can estimate those with some degree of confidence, then if I have at least a 20% margin of safety, it's worth buying. Every single investment decision that you make, every single stock that you buy, it's always a good idea to go through that process so that you know yourself what you believe that share is worth. If it happens, as has happened with both Slack and 2U, that the share price goes down, you should be excited, because you can buy more of those shares at the current share price. Remember that we're dealing with Mr. Market, who is a manic depressive without any medication. And I'll show you the example of this in this graph here of Discovery. You'll recall that we bought Discovery in the 60s. I think it was 68 Rand. We can confirm in just a moment. But look at that share price graph. It's over the last 5 years. Mr. Market 5 years ago thought Discovery was worth 140 Rand a share. Then it continued to go higher, and in 2018, he thought it was worth 180 Rand a share. COVID-19 hit, and he thought it was worth 60 Rand a share, 1/3 of where it was in 2018. That's Mr. Market, because he went from a manic frame of mind into a depressed frame of mind. And subsequent to that, the Discovery share price has recovered to around 125 Rand a share, where it is now. You're still buying into Discovery at 3-year or prices of 3 or 4 years ago. Now you you know what Discovery has done in the last 3 or 4 years. If you don't, it certainly has expanded dramatically the business since those times. It's got a phenomenal partnership with Ping An in China, which is delivering now a big chunk of Discovery's new business. The results were out in the past couple of weeks, and they gave you a really good picture of a company that is extremely conservative. They set aside a lot more for COVID-19. I suppose it's a bit like South Africa's government. When in the early days, when COVID-19 struck, the government panicked, and there were estimations that we would have 350,000 people rather, dying in South Africa. That was the information that was given by the epidemiologists to the South African government. There was this massive lockdown, level 5, put the country sterilized the economy for a number of weeks. But then as things started coming out from elsewhere in the world, and as the health system was not overwhelmed, and as we got new treatments like dexamethasone, which alone, that little drug that Aspen makes, reduces the mortality rate by about 1/5, just that little drug. And they learned the clinicians understood better on how to treat the COVID-19 patients. Suddenly, there was an anticipation by government, or an understanding by government, that it wasn't going to be 350,000 deaths, and maybe we'd get to 100,000. Well, as we know, we still aren't even at 20,000. So there's many arguments, and the Panda guys have been very strong on this, to say that government overreacted, and in fact that we could have done things very differently. The economy didn't have to get smashed the way that it did. That's fine. It's somebody else's argument. That what we need to look at as investors is we can see that in the initial stages after the pandemic, and when Discovery went down to that share price, we weren't taking a bet on whether 380,000 people, 350,000 people, or 20,000 people were going to die from the pandemic in South Africa. What we were saying was Discovery at 68 Rand a share is ridiculously cheap. Mr. Market has got overly depressed, and that the company has certainly made its provisions, and it did, for the worst case scenario. What we saw in the past week or so from the Discovery results is that the actual consequence has been a long, long way from what it had anticipated. So those provisions were excessive, and as a consequence, you've seen the share price of Discovery improve. And I think at these levels, it's probably still very, very good value.
Thanks, Alec. John's brought one out from the locker room here. He says, a while ago, you questioned if Metro Bank could go any lower. Since then, it's fallen 5-fold. What do you think about the current valuation? It is currently 69p, was 500p, so £5 when you wrote about it, and it was obviously substantially higher a few years ago.
Well, we bought the shares at £30, and we sold them at £30 when we had the first cockroach coming out of the kitchen, if you recall. Thank heavens we did that in this portfolio. It then has declined, as you say, to around, I can't remember, at £5 that I thought it could go much lower. I certainly thought at around £1 it didn't look like it could go much lower than that. But it still is, and you might recall, it still was very, very much a high risk situation. Now at 69p, it's even higher risk. But I don't know. I can't invest in companies where, even though their upside potential is substantial, I don't know enough about how many cockroaches have been in the kitchen. So I guess someone could have said at £1 that if this is a stock that's been at £30, is it a good company? We have our UK banking account with Metro Bank. It is a superb company. It's the best bank by a country mile to deal with in the UK. But the problem that Metro Bank's got has been caused by other factors, by different factors. And now it's just completely and totally out of favor. Surely at some point in time, the assets, I'm sure it's trading at below book value. We'd have to have to go and do some research. I've stopped watching it after it got to around £1. We would have to go and do our research on it. But if you are just thinking logically, at some point in time, an asset will be acquired, if it gets cheap enough, will be acquired by somebody at something approaching fair value. And I guess that's really where the argument comes in for Metro Bank. I just know it's a great company, it's a great business, and that has to be reflected at some point in the valuation of the business. It's a bit like Investec. Anybody who banks with Investec, well, not anybody, but most people who bank with Investec know you're going to have to go a long way to get a bank that's even better than that. As much as I love Discovery, Investec's got my banking business and will keep it, and my personal banking business. They just are in a different league when it comes to treating their clients. Is it reflected in the share price? No, because they've had situations which have got very little to do with the way that they deal with clients that are impacting their share price at the moment. But in the long term, will that value be unlocked? Surely.
Thanks, Alec. Joe says, the discount on property shares is very tempting. Should you buy Redefine now?
Joe, I'm sure there are very good reasons why people would project why Redefine is a good valued investment. Again, it's too tough for me to call. My only thoughts about that is that it's not an exponential company. It's not a company that into the future is going to grow its rentals by double figures, let alone the kind of 20% plus that one should be looking for in a transformative economy. And that's really what our portfolio is about. It's about a transformation in the economy. Discovery is in there because it's innovative, it's disrupting, it's doing incredible things, not just in South Africa, but all over the world. It's got a wonderful business in the UK, and the partnerships that it has, the partnership in China is mind-blowing if you just care to spend a bit of time looking at it. When I come back to the alternative to a Discovery, which is in my mind on a growth path, and a Redefine, which is sitting on lots of buildings that every indication is telling us is going to be less likely to be filled than to be emptied, because we've now learned, South Africa's now learned that you don't have to get in your car for an hour and a half in the morning to get to work in the cities, which is where Redefine's buildings are, and do the same in the afternoon, in that you can actually work from home. The technology makes it possible. Maybe go into your office once a week, but you don't have to go in every day as we used to. And if that's the case, more and more you see people who are renting space are cutting back at the very least on the space that they had, because they can have more people working from home. We've been covering this very well in Biznews, Jackie and her team over the past few months. So in that kind of a scenario where your product, in Redefine's case, is office space primarily, is the demand for your product is contracting, but like newspapers, would you be buying into that company? You know, do you want to catch a piano that's been thrown off the roof of a tall building? The problem is you might be able to stop it and catch it, but if it's been, there's also a chance that that piano is going to squash you. It's like what they call catch a falling knife. Don't try and catch pianos, and don't try and catch falling knives if you're an investor. As a trader, I'm sure there's some traders going to make lots of money out of playing stocks like Redefine and so on. But if you're going to buy, are you going to buy it forever? Remember, your holding period for Redefine, for any stock that you buy, should be, according to Warren Buffett, forever. I wouldn't.
There was an interesting Bloomberg article today, Alec, on how this is WeWork's moment to sort of the opportunity for it to grab. So it might also play away from a Redefine investment, this shared local office space.
Well, we see, I mean, we love, again, WeWork is it's what a phenomenal business. It had an impact. It was affected, like Metro Bank was with the CEO there, or the founder of it. Like many other businesses have been, it's affected by external issues. We saw that here with WeWork, but the WeWork business model, or the WeWork value for money that is provided to customers, and the way that the happiness factor of people who use the product is extremely high. And they are, when it comes to shared office space, there's no one even comes close. I know Redefine are trying to play there, and some others. There's a UK company called Regus who try and play there, but it's incomparable. So in time, will WeWork benefit? Surely. Bloomberg's probably done their research. I'd tend, this is as a customer of the company, to agree.
Alec, there's a question on this on YouTube, sorry, from Pete Lowe. He says, it's taken quite a beating since you invested. Are you still happy with your decision to invest? Please, can you remind us of your initial motivation?
U2 is a company that is listed in the United States. It is a tertiary education online business. So what it does is it has relationships with major universities, MIT, Oxford, Cambridge, Harvard, and many universities, and it helps them to take their product online. Now, if ever there was a moment for a company that's in that market, and just to add to it, it is by far the market leader in that area. If there ever was a moment for a company with a model that makes sense, this would be it. The reason why 2U fell, and remember, we buy it over 3 months. So we bought the first chunk 3 months ago, a good price. We bought the second chunk just before the announcement of a rights issue. And that's why we paid over $40 for the 2U shares. But that's the way, you win some, you lose some. If you're buying this thing for the long term, that's the reason you do it. And then we bought the third shares of, let's just go back to it there in fact, I can have a look at it here. We bought the most recent ones at $33.37. Our average price, as you can see on screen now, is $38.65. So in the second month, when we had that ridiculous surge, not ridiculous, but we had that spike in August, we bought at the wrong time. But that's the way we played it. We buy it over 3 months. So the average cost price now is down to $38.65, and the rights issue was around the $38 level. Now, what does the rights issue mean? What 2U has done, because it is growing rapidly, and even more so now when you read the quarterly report, the chief executive will tell you that they did more business, had more inquiries from universities who want them to help take the universities online in the last, or since COVID struck, I suppose it would be now the last 3 months than they had in the previous 12 years. So they're a player, they've been a player in this market for a long, long time. Suddenly people want their services. If they're going to expand, what do they need? They need capital. So they talk to their bankers, Morgan Stanley, who aren't mugs, I can assure you, and Morgan Stanley underwrite a rights issue for them. And the way these things happen, there's talk in the market, the share price goes up. When you have a rights issue as the company, you want the share price as high as possible so that when you announce the rights issue, you can announce it at a discount to the share price, and then shareholders will follow their rights issue. What is a rights issue? It's when a company wants to issue new shares to raise capital. It's not going to help 2U for the share price to be sitting at $30 if they're looking to raise capital, because they then issue new shares at $30, and you can be sure that the directors of the company aren't going to be too excited about that proposal, because that means they dilute their shareholding by more. Rights issues are particularly interesting concepts. We had a similar situation with Tesla, where Elon Musk saw that the share price was overvalued, and he raised billions of dollars recently, just before the share split, or just after, I think it was just before the share split, that's right. So they were in the market, there was lots of talk about the share split. Tesla's price went up to $1,600, $1,700 a share, and they sold new shares, banked the money, and then they did the share split, and then everybody sobered up, and the share price came down to where it currently is. So there's many different dynamics that are working in the marketplace. When you invest in a company, you should just be looking at what do you think the underlying business is going to be doing in the long term, and if the stock market were to close for the next 5 years, would you be happy owning those shares? And in 2U's case, I would be delighted to own those shares, as I do personally, and as we do in this portfolio.
Thanks, Alec. Sharb has two questions on two stocks. Sorry, not exponential stocks though. It's Sasol and City Lodge.
Sasol we know a bit about. We did a lot of homework on them at the time. The share price was falling, if you recall. The CEOs were fired. The Lake Charles thing in Louisiana was overrun. The costs overran. Then you had the collapse in the oil price, and that all combined to get Mr. Market completely depressed about Sasol. And the consequence was that we bought Sasol in this portfolio at 28 Rand a share. It then rocketed up to 140 Rand a share, at which time it became apparent that a lot of the trade that was being conducted in Sasol was being done by retail investors in the United States through a platform there called Robinhood. Sasol was one, as is Tesla and Apple, one of the shares that was among their favorites. When you see a stock that rises to the degree that Sasol had risen over that period, it just pulls in new punters. And as a consequence of that, we saw that Sasol at 140 Rand a share, in our opinion, had actually kind of reached its pinnacle. We couldn't see any reason, any rationale for it to be much above 100 Rand a share, given the circumstances that the company's in right now. And we took the unusual decision for us to sell it at 140. And I say an unusual decision because, like Discovery, we bought into that stock at a time that it was just far too cheap. You can see there, Discovery, we bought at 67 Rand a share. It's now at 123. Had Sasol gone from 28 Rand to 56, a similar kind of thing, or to 50 Rand a share, we'd still be owning Sasol, but we sold at 140. If Discovery had gone from 67 Rand to 300 Rand a share, which is an equivalent of what you're talking with Sasol, well, we probably today would be selling at 300 Rand a share. City Lodge, I haven't looked at it for a while. I can tell you it's a very, very well managed company. I do know the founder, the late Hans Enderli, and he ran an extremely tight ship. Clifford Ross, his successor, similarly. So it's a good company. It's good, solid business. I haven't looked at the valuations lately.
Thanks, Alec. Looks like we're coming to the end of the hour, but a nice one to end off from Deborgo. He says, do you think the infrastructure spend in SA will make any difference to PPC? Or do you think it's just too risky?
That's an interesting one. Very interesting one. If you consider that what happens with infrastructure is one of the biggest inputs is cement, I think you're onto something there, Deborgo. Would I risk the farm on it? PPC's had some difficult times. They've made some really strange investments. I'd love to talk to a guy like John Gomersall, who was the CEO there for many years and then departed, and get his view on it. And maybe we should do that. Maybe we should find out more. I remember Daryl Castle, from who's an asset manager, got involved there as well. They must have seen great value on in PPC. I haven't looked at it for a while. And it's funny. I'm glad you asked that question, because with what we've been doing at Biznews over most of the last 7 years, that we've been going for more than 7 years, is that at the time that we started off, and this portfolio with our partners at Standard Bank on unshared trading, there was very little focus on foreign investors. So we then looked offshore, and as it happens, we've had an incredible ride. But by the same token, we have not been paying attention here at Biznews to the local shares as much as we should have. And so you will have stocks like Afrimat, fantastic little company that's really done well. Italtile, and I'm just mentioning those two because I had a look at them at the same time that we were looking at Wilson Bailey. There's PPC, which is another possible. I just haven't looked at the share for many years. And there are many other companies listed on the JSE. Piet Viljoen, in a recent Rational Radio webinar, said to us that we should have a look at Bowler Metcalf because it was sitting at a I don't know, PE of 1.5 or something. So there are many of those companies that we will be going into and paying more attention to, and it's part of our strategic objective is to massively improve our coverage of South African shares. And I think you're going to see that that will be happening into the into the months ahead. So we're working on this as a team, and we will indeed be picking out some of those gems, because the problem that you've always had in the South African market is it's to many degrees it's been a parallel market. I know this. I listed a company on the JSE, and we could never get a true valuation of our business, because the philosophy was, well, you buy the big companies. If you're buying the JSE, you really are just buying the all share index. But in South Africa, you've got almost 3 markets in one. You've got it used to be the mining shares, now it's really the offshore companies that are listed on the JSE that actually have got very little to do with what happens in South Africa. So call those international stocks. Then you get the big companies that are left. So the first lot is BAT. I doubt that BAT South Africa is even 1% of its turnover. Richemont, similarly, Naspers, similarly, and so on. Then you get the big local companies, which are the big SA companies, which have really been under pressure, Bidvest, Imperial, Barloworld, World, etc. And then you get the ignored. And amongst the ignored, as Pete Fullion was telling us about Bola Metcalf, are many, many, many companies that are offering incredible value. And the reason why we know that is that there's been roughly half of the shares listed in the stock market in the last 3 years have delisted. And why do they delist? Why does a company delist? I'll use my example with MoneyWeb. When the share price was R2, I was quite happy to keep it listed because I had a currency that I could use to do deals with, which we did. We did a deal on Classic FM, rescued that business. We did a deal on a company called Presscon Publishing. We considered other deals as well because we had a strong currency. But when the share price is 18 cents, which I can tell you it was less than a year after it was at R2, you rather say, if you guys don't want the shares, I'll buy them back, thank you very much. And we did buy back a lot of shares during the time that I ran MoneyWeb, that it was my company, because at 18 cents it was ridiculously cheap, in our opinion. And that's what happens when you're running a business. You do share buybacks when your stock is extremely cheap, when Mr. Market is in a depressed mood, and you have other shareholders who are prepared to just throw the shares at you, and you have rights issues or you do acquisitions when the currency is very high. So there are many of these shares sitting on the JSE who are like the 18 cents of MoneyWeb, where the managers look at it and they say, this is ridiculous. If people don't want to reward us or don't want to support us, we'll buy the shares ourselves because we know what they're worth. And that's what the JSE has been going through. Look at the number of delistings in the last few years, and it will show you that South Africa Inc. has got very good companies still, very, very good operating companies that have now been taken off the market. Look at the deal with Comair. I haven't had enough time to really analyze it. But effectively, the guys who are buying it back, ex-managers, are putting up 500 million of their own money or borrowed money or whatever. They'll delist it from the stock market. And because they know the company well, in 4 or 5 years' time, you can be sure they're going to make a very good return on it because they know what they're buying. They know far better than anybody else who's involved there, what they're buying. And that's the game that stock markets show. Now, in South Africa, because of a lack of analysis of the smaller companies, it opens up a huge opportunity for those of us who want to look at it. And I'll just close off with the new show I've got where I interviewed Magda Wazikcha from Signia. And if you listen to that, listen to that interview very carefully, about 3/4 of the way in. The share price of Signia is currently trading at pretty much the same level that it traded at in 2015. And Signia has progressed substantially since then. So I said to her, Magda, any regrets on listing? And she explained they only listed because they were forced to. They wanted to buy DBX trackers, and they couldn't buy DBX trackers unless they were listed because the Deutsche Bank would not sell it to anything but a listed company. And she then said, I said to her, but would you consider delisting, given that the share price has done very little since where it started trading at. And she started laughing. And she kind of giggled a little bit and said, I'm sorry, I can't answer that question. So now I can tell you, someone as smart as Magda is clearly considering buying out other shareholders. The shares don't trade very often. Where they do trade is at a huge discount to the true value of that stock. And she would not be smart if she wasn't even considering it. She can't be the only one doing that. But if Signia were to get a proper valuation in her mind, or whatever that might be, then she wouldn't be dreaming of delisting it. And I think that's really a big message for us here in South Africa. On our doorstep, we've got some wonderful companies that are offering amazing value. Maybe it's time to be doing our homework on them. Sorry for the long answer to the short question, but it's something that we at Biznews are very keen to be applying our minds to.
Excellent. Thanks, Alec. I think we can close it off there. Thanks as always for your time. Very insightful. I've just put that link to the Magna interview on the chat channel for anyone who wants to pick it up. And obviously, I've also put the YouTube channel, which is where we'll put this repeat broadcast as soon as it's been processed. We'll get that online in the next couple of hours. So.
Yeah, and that YouTube channel is a good place to go to. We have all of our webinars there, and they're full of, it's like a treasure chest, isn't it, Stu? I mean, they're just full of great information. Jackie's webinar she does on a Friday with Finance Friday, and then Tim Modise on a Thursday. It's to help us remain informed, and it's all there. All you have to invest is your time.